Hello, my name is Nicole Elliott and I'm a technical analyst and private investor. And on this week's show, I thought we'd look at interest rates, sovereign bond yields. And I decided to kick off with the yield of the 2-year German Schatz. That's 2-year German Treasury paper. And the reason I've picked this one today is that ECB board member Sabine Lautenschläger quit her job at the board. She was the only woman on the board as well. And although she hasn't said anything, and nor has the ECB, the markets believe that it's because she was unhappy with yet another cut in the monetary policy, easing of the monetary policy that was decided a fortnight ago. And if you look at the chart, you can see the big move that we've seen from minus almost 1% to minus 0.65%. And now it looks as if we're on the way down again. The reason the move is like this is that the cut that Ms. Lautenschläger didn't like was actually less than the market had expected. So the cut was a market disappointment, rather like the Fed's decision as well, that they're pushing at the boundaries and there is dissent among those who are deciding on the interest rates. Because we've stopped at that 0.65%, which is a Fibonacci retracement resistance level, I think the chances are that the Schatz will drop back down to 90 basis points. Now, the next chart is of the UK 30-year gilt yield. This is a monthly chart. And as you can see, we have seen quite a big range in August and again in September, the last two candles on the right-hand side of my chart. But the important thing here is that what we did is looking into the abyss, the Brexit abyss, with new record low yield of a positive 90 basis points, the market looked on in horror and sort of kicked back and thought, oh my God, no. And so it went back up to 1.2%, but now again we're on the way down. We've been on the way down first in the 1980s and then kicked in again in the early 1990s. And regardless of what the Bank of England chooses to pick for its base rate, or bank rate as they call it now, the bond market marches to its own tune. In fact, interestingly enough, Metro Bank tried to sell 4-year paper at 7.5% and failed miserably. So the bond market dealers decide what they're going to do rather than being told what they should be doing. My last chart is of the yield on the 30-year Treasury bond. And it's a weekly chart again. We go back to weeklies. And again, you can see we're hovering just over 2%, which was the record low in 2016. And it also happens to be the Fed's target for CPI inflation. And the record low. What we've done here, we've backed up like we did on the Schatz and the gilts, but we're basically getting used to these new, very, very low yields, new reality, and it's at least you're getting some interest here, as opposed to the trillions and trillions which are currently have minus interest rates on them, minus. It's really difficult to get one's head around all of this, but this is our new reality. This is what we're fighting, and the central bankers are beginning to panic, in my opinion. Thank you for watching. I'll be back next week, so tune in and we'll come with more information to help you make money.